These IUL companies, what has happened over the past decade, and I've done a video on this, I'll actually link to this video up right here so you can watch basically the past decade of regulation that has surrounded index universal life, and how what's happened is regulators have been reactive to illicit sales tactics by index universal life companies and salespeople. So what happens is IUL agents and companies come out with new rules, they come out with new features that are kind of designed to be misleading. Hey, it's Chris with Life 180, and for this video, we're gonna be talking about the illicit sales tactics of index universal life agents who are selling no cap indexes and how they are misleading people to believe kind of what they are. And ultimately, I'm gonna educate you as to understanding the ins and outs of index universal life on a little bit of a deeper level. But before I get into that, what I want to do is I actually want to dive right into an illustration for the two top no cap products that World Financial Group sells. And I want to go through product by product and then explain to you why this is such a big problem. And so without further ado, let's just get right into this. All right, so this is the first policy that we're looking at here, the first illustration. And I want to go through here. You see I have a couple things circled here. And so there's a couple elements of this when it comes to no cap indexes that these companies are doing. I used to talk about, and this is the thing, these IUL companies, what has happened over the past decade, and I've done a video on this, I'll actually link to this video up right here so you can watch basically the past decade of regulation that has surrounded index universal life, and how what's happened is regulators have been reactive to illicit sales tactics by index universal life companies and salespeople. So what happens is IUL agents and companies come out with new rules, they come out with new features that are kind of designed to be misleading. And so then regulators come in and they say, okay, that's not okay, so we're gonna create regulation AG 49. And AG 49 makes it so we can't illustrate such high illustrated rates. And then what happens is these insurance companies come out and they say, well, we're gonna get around that. We're gonna create these other components to the policy. And so then they do that for a little while, and then the regulators go, well, there's so many class action lawsuits, so many problems with this. What we're gonna do is we're gonna come out with regulation AG 49A. And so what these companies did after regulation AG 49A, and like I said, if you want more detail, go to the other video. That is not the purpose of this video, is to get into the detail of all that. But when regulation AG 49A came out, these companies came out with no cap indexes, and they came out with proprietary indexes. Once again, details in the other video as to why that's such a big deal. But for the sake of this video, I want to break down how misleading this kind of no cap concept is, because it's extremely important. Because what used to happen is these insurance companies, they had the ability to manipulate cap rates, and they had the ability to manipulate participation rates. And when while that's not happening anymore, while they've shifted and they're not necessarily manipulating cap rates because they don't have a cap rate, that's the whole purpose of creating a no cap product. When you understand how they actually participate in the index, you understand that there's really nothing you can do to really change the overall performance, because you can't draw blood from a rock, and I'll explain that to you after I go through this. Now, here's the deal with the no caps. When you look at this product, this is the Symetra. Now, they have a couple no cap options in the Symetra product. Now, you can see here the Putnam Dynamic Low Volatility Index, or Excess Return Index. You can see that there's no cap, and this is what's being sold. There's no cap. So they get around the old argument, right, of the fact that cap rates can be reduced. So the argument is, hey, if the cap rate can't be reduced, then you know, how are we to argue that, right? But guess what? Now, and they also say the index floor, you're guaranteed to have a 0% floor. That's great. Now, the participation rate, this is saying it's a no cap with a participation rate of 125%. That means if the policy does 10%, you get 12.5% return in your fund. Now, the participation rate right now is 125%. This is where the insurance company protects themselves. They have the ability to reduce the participation rate, you can see right here, to 50%. So they have the ability to manipulate that and say, instead of earning 12.5% on that 10% return, you could earn 5% on that 12% return. on that 10% return. And so that's one component. Now, another thing that's going on here with another option with Symetra, is that they have a no cap, once again, and you can see the index spread rate. So the index spread rate is an important number to know. The spread rate is really how much the market has to earn before you start earning anything in your policy. It's like you minus that number, that spread rate, off of whatever the return is. So for instance, right now, the current spread rate is 5% right here, right? So that means if the index did 10% for a return, you would minus that 5% out. Now, while this policy has no cap on it, look at this, 20% is the spread rate that is guaranteed. What does that mean? That means this company has the legal contractual right to increase the spread rate all the way to 20%. So what's happening is all these IUL agents, especially at WFG, are now selling this product as this thing that has no cap, that is upside potential, like through the moon. And I'm not going to deny, right now they illustrate really well. They look really good. But I'm telling you right now, the history is these companies always reduce cap rates, increase charges, do whatever they have to do to control it so you're the one holding the bag. I see it all the time. And in this situation, instead of having a cap rate to reduce, which impacts your performance, they have spread rates that they have the ability to increase. And in this situation, imagine if the company increased the spread rate to 15%. That means that the index would have to earn 15% before you started to earn anything. So ultimately, the reason I got out of selling IUL, and I used to be the head of business development for the #1 IUL company in the country, and the reason I got out of it is because in my conversation with the people that designed the product there, they told me straight up, the purpose of IUL is to get a decent enough return to be able to give you a little upside potential, but the real purpose of it is to shift the risk from the insurance company to the insured. If you go back in history and you look and you understand that life insurance companies are the #1 managers of risk on the face of the earth, and you understand that they did this at a time where they saw, because they look at 30-year increments when they're making their plans and when they're managing their assets, they saw the fact that we were entering this long-term low interest rate environment. And that's why you see in the mid-2000s, that's why Index Universal Life started gaining steam and started getting popular, is because they saw this coming. That's why it got even more popular and accelerated with growth after 2009. Interest rates just kept plummeting. General funds had a hard time getting their returns. There was more risk in the insurance companies, so they shifted their book of business to a product that shifted the risk from the insurance company to the insured. And you can see right here, while these look really good, it's all about smoke and mirrors, it's all about hype, and it's all about making you think that these are going to be awesome. But I promise you, if you buy a policy like this, it's going to leave you severely disappointed, because the insurance company long-term is always going to move these numbers in their favor and against you. So no matter what it illustrates at, remember, it's illustrating with these current assumptions, and they will get worse. They just will. Now, this is the core options down here. Just because I have it here, I'm going to just kind of show you. You can see that the S&P 500 index, this is the old school way of doing it, is a 9.5% cap, meaning if the market does anywhere from 0 to 20, you're going to get whatever that number is, up to 9.5%. So if it did 7, you'd get 7. If it does 10, you're going to get 9.5. If it did 15, you're going to get 9.5, right? So that's just the way it is. But here, once again, the guarantee, they have the contractual right to be able to reduce that cap rate to 2.75%. So you can see these numbers and the legal right. This is why I love whole life insurance compared to IUL, because these are sold as being this sexy vehicle that's going to be designed to accumulate a lot of money. But when you look at this, the insurance companies utilize the low current rate, the high participation rate. They utilize these as marketing expenses. They actually write that off as a marketing expense. They know that these aren't going to do this. They're not going to perform this way long term. They know that they're going to reduce these rates. They're going to release new products. They're going to reduce this, and they're going to have the sales team sell the new products, and the people with these policies are going to be left holding the bag. So that is the Symetra one. Now, what I want to do now is I want to hop over to the Nationwide one. This is the other preferred product of World Financial Group as far as no cap products go. Now, here you can see They have a 1-year uncapped S&P 500 index. I highlighted it in red here. This is just the index. And you can see here right now, the participation rate is 100%, and that is guaranteed. So this is sold to counter the old argument where they can reduce cap rates and they can reduce participation rates. So what do they say? Well, it's 100% guaranteed participation rate and there's no cap. So how can you argue with that? Well, instead of that, we're gonna add in a spread rate. And the spread rate is 7.5%, and they're guaranteed, they have it guaranteed at 10, meaning they have the contractual right to raise it to 10%, meaning, once again, the index has to, in this instance, it's the S&P 500, would have to do 10% before you earned anything. Right now, it's 7.5%. Oh, and just as a side note, I gotta say this now, I gotta go back here, I forgot to mention it. With the Symetra, this is all a proprietary index. So this has all been done on speculative, here, hold on, let me go back up here, I gotta show you this is mind-numbing. It's right here. So you can see here with this index right here, it's a historical, hypothetical allocation right here. And so this goes to show that all the numbers down below that they give you and that they're selling on, it's a proprietary index that was built with hindsight being hypothetical, and with full transparency, they kind of have to acknowledge in very small print, but nobody reads these contracts because they're 48 pages long, and look at this fine print, right? So only a nerd like me is gonna go through every line on this thing like this. So hypothetical back-tested data has many built-in limitations, some of which are described below. Hypothetical backtest performance data and other data such as hypothetical asset allocations presented reflects application of the current index methodology and selection of index constituents prepared with the benefit of hindsight. No theoretical approach can take into account the factors in markets in general and the impact the decisions that might have been made during the actual operation of an index. Simulated performance data is based on criteria applied retroactively with the benefit of hindsight and knowledge of factors that may have positively affected its performance, and may reflect a bias towards strategies that have performed well in the past. Back-tested performance data and hypothetical asset allocations do not reflect performance or actual asset allocations of the index. Actual results may vary, perhaps materially, basically perhaps significantly, from the simulated results present. So what they are saying here in very, very small fine print that I had to basically read with a microscope is the fact that we built this with back-tested information. We built it with hindsight. We built it with full clarity to be able to design it so it looked really good, right? But even though we did that has no bearing on anything. It has really no indication. Just because we have it and it looks this good doesn't mean it's going to perform that well for you going in the future. So just know that that's the case. Now, when we get over here, this spread rate, they also have an index interest strategy charge rate, and this is for the S&P 500. So while you'll notice the numbers are smaller here, but that's because it's not a proprietary index that's designed to be inflated and just extreme. The S&P 500 is very predictable. It has a lot more trust, and this is one of the reasons they have smaller things, because smaller numbers, because the numbers are going to be smaller in this policy, and as far as the expectations and the rules around the S&P 500, just how it grows. And so when you look at this, you can see this 10% guarantee, and then the index interest strategy charge rate is 50 basis points. So here's the deal. This is at the end of the day, you cannot draw blood from a rock, and you have to understand that IULs are simply an options product. And these products, once again, this is saying this company has the ability contractually to make it so the S&P has to do 10.5% before your IUL earns anything. And if you look at the history of the performance of the IUL, that doesn't bode well for you and your policy. All right, so what I want to do now is I want to show you why it doesn't matter if it's an uncapped index, if it's the S&P, if it's an uncapped S&P, or if it's a normal S&P. And I'm just going to use the S&P as an example. Now, where it gets a little hairy is in the proprietary indexes, because those indexes are designed specifically, and I've got other videos that will get into detail on why proprietary indexes are so bad. And actually go watch this video up here if you want to watch one of the top videos that is going to break that down. Go check that out. But the overriding principle here is that you have to understand that IULs are not an index product, they're an options product. And when you understand how they participate in the options, you understand that whether there's a cap, a participation rate, no cap, a spread rate, anything of that nature, it's all just moving parts. The company is dealing with the same numbers going into the policy, and they have to mitigate their risk no matter what. And they can only create returns based on what they do in the options market. And so that doesn't change no matter what. So here's the deal. This is what happens. So when you look at let's just say you have a $10,000 cash value, right? That's maybe you had a $12,000 premium and you have $10,000 accumulated value, something of that nature. So what the insurance company does is they say, okay, we know that we have 4% return in our general fund. I'll call it the GF. So 4% is what we know for the general fund that we're going to get for a return, right? And so in that 4%, we know that you're going to have $400. So the $400 then is going to be used to buy options. So here's the deal. A lot of people think that cap rates are changed, participation rates, spread rates, all this stuff are changed based on the performance of the index, but they're not changed based on the performance of the index at all. What they are changed by is based on this number, what they're going to be able to get based on fixed assets in the general fund. And so they're based on that number, and they're also based on the cost of options. And so here's the crazy part, and this is why I say these no cap products, they look really good, they sell really well, but they're really, really dangerous. And the reason they're dangerous is because we're coming into a time where the market is not going to bode well for IULs. And here's the thing, this is the funny part to me. Now, I have an IUL challenge out there that shows if you can show me the original illustration that was submitted with the original policy that was 10 years old and out of surrender period, and you show me the current in-force illustration, if that in-force illustration outperformed the original illustration, I will give the agent $500, right? And right now it's actually up to $750. So that's the deal. That is the challenge. Now, if that challenge hasn't been, I've got over 85,000 views of content with that, and not one person has been able to send me the illustration. I had one guy that made a video, and that video, quite frankly, is a joke. And there's all sorts of third-party software out there that can make that video look like what it is, right? And if that's the case, and if it's really that good, then send me the illustrations, and I'm happy to pay up. I mean, quite frankly. And so here's the deal, though. We just got through the greatest bull run of the market in history. So the fact is, the fact that my inbox is not flooded with people that are just wanting to give me illustrations showing how amazing these IULs are during the greatest bull run, because if they do so well, we just had this awesome market, the products should have performed, and they didn't. The fact that 95% of policies, even the ones that were designed mediocrely, the market is really good. Now, the past 3 years, there's a lot of policies that have performed well because the interest rates have been good, because the policies are so new, and so they're going to look like they're doing well. But that's kind of like what happens is that's the effect of IUL agents that have sold those policies, basically feel like they're good money managers in the same way, or good product designers, or good financial coaches or advisors in the same way that a lottery ticket winner feels like they're really good at managing money, right? That, you just got lucky. That's really what it is. We just got through the best environment that we've ever gotten through with the stock market. In the next 10 years is not going to be so lucky, and this is where it gets dangerous, because what's going to happen here is we have an environment where we have to buy options, and this is when the company has the $10,000, which leads to the $400 of a budget. Then it goes and buys options. Now, if you understand anything about options, you know that they're not designed to get great returns, especially the way IUL companies use them, they are designed as a hedge. That's why if you read through these illustrations, they often don't speak to options specifically. They refer to it as a hedging strategy. And so the hedging strategy here is options. And basically the reason they've had to reduce cap rates and the reason they're going to have to reduce or increase the spread rate, they're going to have to increase or reduce the participation rates in policies where they can. But remember, the math is the math. It doesn't matter how they have it designed. They're always going to protect themselves because that's the purpose of this product. And so here's the deal. They take this budget, they go out and they buy the options, right? And so they go buy the options. And if the option comes in and does well, you get more money, right? And if the option does not do well, then you lose this $400 and your $10,000 of accumulated value is protected. That's how these work. Now, here's the deal. Going into the future, when you understand how these work, I'm going to just erase this for a second. When you understand how this works and what we're going into the economic environment going into the forward, a lot of people are going to say, whoa, hey now. A lot of people are going to say that, well, Chris, the general funds are going to do better, so that 4% is going to go up, right? But here's the deal. We're seeing as interest rates are going up, what's happening? S&P performance is coming down. So even if this goes up and it does better, that it's negative environmentally because, you know, whereas before the spread rate is 7.5%, in a high interest rate environment, the stock market typically doesn't do as well. And so therefore this 7.5%, this 7.5 is harder to hit. So the S&P 500 isn't going to perform as well, so your policy is not going to perform as well. Now, on the other side, what do we have in a higher interest rate environment? We have option volatility. Now, option volatility is going to increase the cost of options. And this is what's been happening, guys. During the greatest bull run of the market, options have been going up in cost. And what that does is that is the reason that they've been reducing cap rates. It's not because the market's sucked. It's because the options market has become more competitive. It's gotten more volatile because of the market volatility, because of competition. It's all supply and demand. Supply and demand is why they created these proprietary indexes with back-tested hypothetical garbage that makes them look way better than they really are. And then they tell you in the small print that that's the case, but the salespeople just omit those facts. And so the bottom line is when we look at this from this perspective, the market volatility the market volatility leads to increased options expenses, which means right now it means basically you can buy fewer options. If we have this $400 budget, we can buy that leads to options, but it's fewer options that we can buy. Now let's say the interest rates go up to 6% in the general fund. Now we have a $600 budget. But what that's going to do is it's going to create more volatility in the S&P. It's going to create more volatility, which leads to higher options price. So as that goes up, the options prices are going to come down again. So they're still not going to be able to increase those rates. They're not going to be able to increase the performance. Now, this is why I love whole life insurance. This is why I say I believe whole life insurance will outperform what we see right now, because what we're seeing right now is they're completely stuck to they're completely connected to the fixed rate. When you are a whole life policy holder, you are no longer just a profit center for the company. You are a shareholder, effectively, of the mutual company. And so right now they're 4%, but as the dividend rates go up, let's say the general fund performance, I'll call it GF, as the general fund performance goes to 6%, the dividend rate will go up. So when the dividend rate goes up, that means your performance of your policy will improve as well. And so when you look at this is why I say the next 10 years is going to bode better for whole life insurance than it will for IUL. And that's why I think these illicit sales tactics when it comes to IULs, people need to understand that it doesn't matter if it's a cap, if it's based on the participation rate, if it's a no cap based on the spread rate, based on other investing and crediting strategy charges, all these different things, they all come into play. The bottom line is it doesn't matter what index it's in. It doesn't matter what type of strategy it is. No cap products are not no cap products purely. They're simply participating in the index, and the only way they can participate is by taking the general fund, creating an options budget, buying an option, and then that option will perform. It doesn't matter how it is, they have to control their exposure because they can only pay you based on what that option gives you for a return. And it doesn't matter if it's a capped index or a no capped index, they can't give you any more than what the option will return. So all of the indexing strategies that you see is simply optics, and it's semantics, and it's smoke and mirrors, and it's designed to get you into a product that you don't understand, and it's designed ultimately to shift the risk from the insurance company, where they hold all the risk on the whole life insurance side, and shift the risk to you, the policyholder. So if you have any questions, go ahead, let me know, comment in the comment section below, and yeah, I hope this makes sense. I'm sure I'm going to get a lot of love and a lot of hate on this one. So have a blessed, inspirational day. If you haven't already, make sure you subscribe, hit the bell. That way you get notified every time I launch a new video. And that's it. Take care.